Ladies and gentlemen, good day and welcome to earnings call of LMW Limited for quarter 3 of FY2025-26 hosted by NSDL. As a reminder, please note that the participants line will be in listen only mode and there will be an opportunity to ask questions after the brief by the company officials. Should you require any assistance during the conference call and raise questions, please signal the operator by raising your hands. Please note that this call is being recorded. This is Samir from NSDL, and we have with us Mr. V. Senthil, Chief Financial Officer, and B. Dhanalakshmi, Associate Vice President of the company. Over to you, sir.
Thank you, Mr. Samir. A very good afternoon to everyone, and thank you for joining LMW earnings call for Q3 of FY25-26. I will brief about the overall performance of the company for the period ending December 25, followed by an interactive session. I would also like to clarify that certain statements made in the discussion during the call will be forward-looking in nature. To begin with, let me explain the overall performance of the company, then we'll go into segment-wise and consolidated performance. The financial results have been posted on the company website, and I hope you had an opportunity to go through the same. The revenue for the quarter ended December 25 is 767 crores as against 776 crores for September 25, which is flat. For the 9-month period ending December 25, the revenue stands at 2,228 crores as against 2,120 crores for the same period for the last year. The PBT for the quarter stands at 56 crores as against 59 crores for the immediate previous quarter. And for the 9-month period, it stands at 149 crores as against 93 crores for the 9-month period for the previous year. There is an exceptional item of around rupees 11.5 crores during the quarter and period ending December 25, which is a one-time impact on account of the new labor code regulations. And for the period ended Q3, there is a 1.29 crore which was incurred towards VRS. Going to division-wise details, TMD revenue stands at 440 crores for the current quarter as against 461 crores for the previous quarter. And for the 9-month period, the turnover was 1,316 crores compared to 1,347 crores for the same period during the previous year. This is a reduction of around 2%. The overall loss for this division in the current quarter stands at 3 crores. In the period to date, the loss is 1 crore as against a loss of 23 crores during the last period ending December 24. With respect to the order book, we currently hold an order book of 2,600 crores, of which the actual orders are around 1,500 crores. With respect to the sales which has been clocked during the 9-month period, the ratio of domestic to export to spares stands at 65% domestic, 9% exports and 26% spares. As we have mentioned earlier, we continue a 5-day working week for textile machinery division on account of lower capacity utilization. This trend continues to be monitored, and depending on the order flow, will take the next course of action. With respect to LMW Global, the turnover for the 9-month period stands at 128 crores as against a comparative number of 75 crores for the period ended December 24. For December 25, the loss stands at 25 crores for the current period as against a profit of 1.5 crores for the previous period and the period. And the order book for export stands at 139 crores. In LMW China, for the 9-month period ending December 25, the turnover stands at 52 crores, and for the comparative period last year, it stood at 54 crores. The loss for the current period is rupees 11 crores as against a loss of 4 crores for the previous period. The order book on hand in China is rupees 6 crores. Now I move to Machine Tool Division and Foundry. The revenue in Machine Tool Division and Foundry stands at 853 crores for the 9-month period ending December 25 as against 728 crores for the corresponding previous period. Out of this, around 12% relates to foundry division. The balance top line is towards machine tool division. With respect to ATC, the revenue for the 9-month period stands at 150 crores for the 9 months, as against 123 crores for the corresponding previous period. At a consolidated level, the revenue stands at 2,274 crores for the 9-month ended December 25, as against 208 crores during the corresponding previous period, and the profit at rupees 104 crores as against rupees 90 crores for the corresponding previous period. With this brief, I would like to continue to the interactive session. Over to you, Mr. Samir.
Sir, thank you so much. Going ahead, next we would request the people in the attendees to please raise hands so that your questions can be taken forward. So we have our first person in the attendees who would like to proceed with the questions. We have with us Mr. Divyam Doshi.
Hello, sir. Good afternoon. And I wanted to ask that in the previous con calls, you had mentioned that demand was supposed to pick up after the Q, uh, after 9 months or approximately after December. So, what is the current scenario? Is the demand showing up for the um, sector? And also, I wanted to know how is the uh, management guiding towards the recovery of revenue?
Um, Mr. Divyam Doshi, do you have any other questions apart from this for TMD?
Yeah. So I'll ask one more question.
Yeah, please
S-
go on.
yeah. So we have seen that. Just a second, sir. Huh. Um, what are the other indicators that you are tracking apart to show that the demand has been shown? That's it.
Again, this is related to textile machinery division, I suppose, right?
Yes.
Okay. Anything on any other divisions?
No, sir.
Okay. Thank you. Thank you for the call. Thank you for the question. With respect to the previous our anticipation, yes, we have anticipated that since the downturn has been a sustained one and it has extended almost now close to 2 years, the anticipation was that the demand would pick up, and this is indicative of from the historical data what we have seen in the past. However, the factors which are affecting, especially in terms of tariff which has come in, these are the things which have were not factors which we know of in the past. So this is a business where we have always seen 8-year cycles, and this 8-year cycle of going up and going down, where there's a consistent increase, has always been noticed. So our anticipation was that post slowdown of almost 18 months, there will be a bounce back. And this has not happened because of the uncertainty on the demand side. Having said that, what we still um, anticipate is that during this time as well, within India, there has been a consistent utilization of spinning mills at a fairly high level, and the mills which continue to operate are waiting for certain indications. Now, those indications would be one of the things which has come recently, of course, is the EU FTA, but even before that, there has been good amount of incentivization, not incentivization, at least good amount of policies from the government, be it GST, be it PM Mitra parks, which has been given. So these are all the right actions which has been taken. So it is only the confidence which has to come back into the industry that it is a sustainable long-term demand would be there. and we will see investment coming back. With respect to the indicators, for us, one of the key indicators is the order flow. And we do note that the current year, actually compared to the current year, when I say it's the 9 months, the order flow has been definitely better than what it was in the previous 12 months, right? So yes, there are indicators, people are investing, we are selling, but at the same time, the confidence level is not very high, and a lot of external factors are uh, postponing the day. Because of the external factors, there is postponement of decision. But we look out for, whatever is the order flow and how we can get more orders into the system. So I think back to you, Mr. Samir.
So thank you so much for answering that one. I believe Mr. Divyam has a follow-up question or another question.
Yeah.
Yes, sir.
So, just as you mentioned, what if the textile cycle remains weak for another 12 to 18 months? What are the levers that we have to protect our profitability or cash flows?
Yeah. So thank you. So what we do, and this is the right time, and this we have done multiple times in the past as well. This is the time for us to become lean. This is the time for us to increase our efficiencies, and this is the time for us to invest. We continue to invest in our uh, shop floor. We done, and today the technology has changed. We continue to invest in IoT. We continue to make our process efficient and costs efficient. And these are the time we also invest in our new product development. So these two factors is what we use our time for during a downturn. Because effectively what happens is the demand from customers are more stringent, because customer is also trying to struggle and survive the downturn, right? So we have to be cost efficient and we have to pass on that, and that's what we best try to do. So both ourselves and from the customer point of view, we have to work towards a much better product and much better organization, and that's what we invest in. So one of the example is what we have just now said. We have a very small VRS scheme. We did announce we are trying to cut down on the costs of and also on the fixed costs. So we have to tighten our belts, and and we do that during all the lean periods. It is a very long lean period, but we have to continue to do all these activities on a continuous basis. Back to you, Mr. Samir.
So thank you so much. At the moment, we do not have any hands raised. Once again, we would request the people in the attendees to please raise your hands if you have any questions. For the next question, we have with us Mr. Manish Goyal. Manishi, over to you.
Yeah, yeah. Thank you so much. Very good afternoon, sir. Sir, can you repeat the subsidiary numbers for Global Dubai and for the China? And what I probably observed from your segmental numbers is that in consolidation, the losses are much higher than the standalone. So, like to know what is it pertaining to? What has led to increase in losses? So that was my first question. And also, if you can give some perspective about demand outlook for machine tool division. We have seen some improvement on revenue growth as well as on the some bit of inch up in margin. So how should we look going forward over the next 6 to 12 months on the MTD? And on ATC, sir, how is order book building up over there? We now for the first time have seen a double-digit margins. Can we see the momentum continue on both revenue growth and margin improvement, sir? These are the three questions. Thank you.
Thank you, Mr. Manish. Thank you for the questions. So with respect to the subsidiary, I would repeat those numbers. For the 9-month period, we did a turnover of 128 crores at LMW Global. And at China, for the 9-month period, we did 52 crores. The increase in loss, I think we have clocked around loss in both these divisions, because the increase in loss on account of now the entire global setup, the export setup having moved under holding company. Have a host which holds both these companies, and then the entire costs are all with the holding company. The entire decision making is there. All the 7 or 8 odd countries where we have offices all report into that. The normal turnover as a percentage, if you see, exports always used to be clocking around 20% to 25% of our overall turnover. But considering the countries where we are operating, none of those countries are doing well, and our export as a percentage of volume has shrunk to, like I said, in the current state, it is around 9%. 9 to 10% is what export volume is. And this is not absorbing these costs. It has been a tough situation. In fact, Bangladesh, Turkey are key countries for us, and they have their own challenges. And other countries, definitely Indonesia is doing well, and Vietnam to some extent is doing well. Egypt and few African countries and are looking at further investments. Egypt, there are some investments coming in, but it is taking time. I think the challenge what we see from in India is similar, very similar to what we are seeing in other locations as well, right? And China in itself is investing, but it is very specific to 1 or 2 large orders where the investments are going in. So there is a challenge there as well, and that is where we see that we have spent so the entire spend which has moved to our holding company. There is a loss because of that. But having said that, it's the same case everywhere. Investments are not happening. Investments will happen. It is only a matter of the right opportunity and right conditions for investment. Today, having said that, if you look at tariff, both Egypt and Turkey, in fact, have the lowest tariff. But because of the economic situation, Egypt, there is more investment discussions going on compared to Turkey. So we feel, yes, this will there will be turnaround. It is only a matter of time and the right conditions around this. And that is point number 1. With respect to the machine tool division, yes, we are quite optimistic about machine tool division, especially the fact that we are seeing more numbers on the machining centers, VMCs. So the demand outlook is quite strong. We are very positive about continued growth in that sector. And within that, between turning centers and machining centers, we are working more on the machining centers because that is where we will be building higher market share because of the new products what we continue to introduce on the machining center side. There are certain within machining centers, you have vertical and horizontal machining centers. That is a subset of the machining centers, but this is a sector to focus on. And this is a sector where we have introduced machines over the last 5 years, and we continue to expand our footprint as far as machining centers are concerned. So very positive as far as the machine tool division is concerned. The capacity utilization within the machine tool business today, still we have bandwidth to grow there. We still are clocking only 75% capacity utilization, so there is enough space for us to move and deliver for the balance capacity which is available within the machine tool division. Now coming to the ATC order book, we have built like what I mentioned in the previous call as well. A lot of RFQs have been floating. We have been able to get quite a few RFQs. The number what we had given out last time was we got an order book for delivery of around 300 crores. Definitely, the order book is definitely growing. It is the only unknown, the factor which is affecting is this, there's a tariff impact. And for us, ATC is almost 90% export. But as of now, with we do not see much of a push out at the moment. However, a lot of discussions do happen between us and the customer as to how to handle it, and we hope uh, this continues with respect to the negotiation and getting some relief on the tariff. But that is the only challenge as far as ETC is concerned. But otherwise, in terms of order booking, in terms of winning RFQs, in terms of building a longer order book, I think it is quite positive there. In fact, we have continued to invest even the current year for in ATC because of the new orders which have come in for delivery. I think the order book number which we have given last time, around 300 odd crores, it has gone up to by another 20%. It is around 360 odd crores, which is deliverable over 1.5 years. That's what it is. So long as there are no push-outs, etc., I think that is something which very much is going on the positive trend. Over to you, Mr. Samir.
So thank you so much. Once again, we would request people to please raise hands for further questions. So going ahead, we have with us Mr. Krunal Shah. Krunal sir, we are ready for your questions. You have already been unmuted.
Yeah, hi. Thank you for the opportunity. So I have two questions. One is on the this free trade agreement. Is there any provision for us to export over there, and is there any duty exemption that we are getting with the exporting to Europe? And second question was, during the quarter, we sold a stake in a group company, Super Sales, of around 10%. So just want to understand what's the logic behind selling this stake. Is there some internal restructuring that is happening? That's it. Thank you.
With respect to the EU FTA trade deal, there is no specific impact what we see from import into India point of view, because yes, there are missions which come into India, and today also the missions can come into India at zero duty. Yes, there will be little more imports, but at the same time, the value at which these machines are imported is fairly high. So the implication with the duty would not be much. With respect to exports, it supports our customer. We as such from textile machinery or machine tool are not exporting into Europe. Of course, there is an opportunity. Definitely, it opens up an opportunity for us. But at the moment, as it stands, we don't have an export sale into Europe as far as machinery is concerned. But from a advanced technology center standpoint of view, definitely yes. Like I said, 90% of it is our exports, and more these exports are mainly to US, and we are also exporting from foundry division to Europe. These things would be a lot more cost competitive as far as the exports from ATC and foundry is concerned. Foundry, we have customers. ATC is something we definitely will be looking forward to building a new customer base within Europe. I think it really supports us on that front. With respect to super sales, It was not a core investment which we wanted to hold, and that is the reason we have sold the shares of Super Sales. Over to you, Mr. Sandeep.
So thank you so much. Going ahead, I believe Mr. Manish Goyal has a follow-up question. Manish, sir?
Sir, two questions. One, if you, what I asked earlier was, I didn't get the loss number for Dubai. Dubai,
Yeah, sure.
and what was the competitive number for the 9 months? Yeah.
Just 1 second. The loss for okay. Any other question, Mr. Manish?
And can you give us revenue breakup for the current quarter for TMD and the comparable number for the quarter? And the third question on ATC in terms of composites business, we were expecting some orders to 55. So any progress on that? And because this quarter the margins have picked up, so is it that composite business has also picked up and started contributing apart from metallics? That was the third question.
Okay. I think from the last number of Dubai for 9 months it is 25 crores, and for the last number at China it is 11 crores. The comparative number for Dubai was 1.5 crores profit last 9 months, and it was 4 crores loss in China for the previous 9 months. That is point number one. With respect to TMD, the breakup of that 65%, 9%, and 26%, that is the OEM sale, export sale, and spare sale, remains same between this quarter and the previous quarter, not much different. With ATC composite, yes, you're absolutely right. Okay, composite as a percentage of the turnover, what we see around 150 crores, the composite as a percentage of turnover stands at 20%, right? And yes, there was billing on composite for few items, and that is where the margins have become better for the current quarter. It will come back to normal, but yes, we are able to start billing for composite. And just to recap, this composite facility was always built for our space program initially, where we have done the launch of the Bahubali, which got launched, the entire the nose cone, and also some of the key parts have come out of this facility. However, over last 1.5 years, we have pivoted to also doing anything with respect to advanced technology, with respect to space, aerospace, etc. And that is where we are pushing for a better utilization of the plant in composite, and we are starting to see the billing on composite from last couple of quarters in a small manner, but overall turnover of composite in this continues to be at 20%. With respect to the order book building, which I did mention in the previous question you asked, I would like to still state that the order book building has happened mainly on the metallic side, and the investments which have gone in the current year have also happened on the metallic side. Because on the composite side, we have got enough investments which have already gone in, where the utilization has to go up by more orders to be executed. Okay. Back to you, Mr. Samit.
Thank you so much, sir. Going ahead with our next questions, we have Mr. Jay. Mr. Jay, you have been unmuted. Can we
Thank
have
you.
your questions, please?
Yeah. Thank you, Senthil, for this opportunity. Trying to understand better on the textile machinery division, Senthil. Is there any kind of an understanding that we can have of the age of assets which are currently in use as an industry data that you can indicate towards? Or is it fair to try and understand if your spares and repair revenue growth over the last 3 years has expanded faster, suggesting that the assets in use are aging. And alternate, you also spoke about the fact that for whatever spinning mills are in business today, implying some kind of consolidation. So I just wanted to get a sense of if any of these data points can be used better to arrive at a potential recovery of the cycle. And the second question, sorry,
Yeah,
go ahead.
please go on. No, please go on. I was going to ask you this. What is the second and subsequent question? Please go on.
So the second question is that what is the contribution to revenue today from the latest 3 products, let's say, that we launched in the last 2 years, such that we get a sense of how those efforts have started to pay off or not yet contributing enough.
Okay. Any other questions?
No, that's good for now.
Okay. I think it's a very, very good question, Mr. J. I think from a industry spindleage standpoint, we would put the current spindleage between 40 to 42 million or 40 to 44 million, give or take, few million. So out of this, we would say almost 40% would be older spindles, right? 40, which is, when I say older spindles, we are talking about 15, 20 years and above. We are also clear that the current spares which we see is basically because of the consistent increase in spares, consistent performance is coming out of 2 things. One, our continued focus within the spares business, because spares is a large business volume. Our continued focus from LMW on this business, we have done a few things. We have a separate division within textile machinery for that. We have increased the footprint within India. We have established our warehouses in Indore, for example, and we are in the process of establishing others as well, where the reach to customers is a lot quicker, where we are trying to not only deliver after a particular period time, but try to get it as quick as possible from the time of order. So with the possibility of doing a better service to the customer, that is an indication of how the turnover has increased. This is from what LMW has done, but from a spindle usage point of view also, if you look at all the spinning mills, yes, because certain spindles have shut down, the running spindles are running at almost full capacity. And you can talk to any spinning mill and they'll fairly give you at 95%, 90% and above utilization, or 95 and above utilization. So the consumption of spares has been also consistent. It has not resulted in a dip, dip in spares consumption. So it is factor of 2. Aging of machines, I think that most of the machines which probably shut, I would attribute it to older spindles and smaller units which has got shut. But at the same time, the reason for spares I mentioned are twofold. With respect to again going back to the spindles as such, there is a lot of incentives today for spindles to be established or new mills to be established in various states. There are state incentives, there are central incentives. So now, like I mentioned, it is the confidence level at which we can invest and people can commit, the investors can commit to these investments. And that is where, whilst we do have a lot of discussions, we have a lot of customers who are discussing on investment, their decisions are not coming forward because of the uncertainty around what is going to, hit us. And definitely the tariff has been and also has been a major factor in this, for the decisions not to come through. With respect to the NPD in we don't want to give out the NPD number or exactly what you're asking for. So I may not be able to give you the NPD number, but what we do inform, and in fact, in the last exhibition also we have shown our auto winder, our Lakshmi winder, our there's a new 1.2, 1.25 or 1.28 card machine which has been launched, and a new draw frame which has been launched. So we do track them for market share in these independent segments, but we don't give out the NPD percentage. Over to you, Mr. Samir.
So thank you so much. At the moment, we do not have any hands raised for further questions. The people in the attendees, if at all we have any questions, please do the needful. Okay, now we have one. The next questions would be from Mr. Amit Shah. Mr. Amit, you have been unmuted. Can we proceed with the questions, please? Mr. Amit, you have been unmuted since you raised your hand.
Yeah. Hello.
Yes, sir.
We can
Yeah,
hear you,
sir.
Mr. Amit.
Yeah. On the MTD side of the business, and I wanted to understand the business prospects of the 5-axis machine that you have launched, and incrementally what sort of contribution that product has done in the MTD side of the business. Incrementally, sir, we also understand that Foxconn is planning to install a new factory. So any incremental development that we have on the 5-axis machine that we had launched. So that's the only question I have.
Okay. Thank you, Mr. Ahmed. Mr. Ahmed, okay, when you say Foxconn, I assume you're talking about electronic machining, right?
Yes, sir.
Okay. Okay, I think these are two different points, Mr. Ahmed. One is 5-axis machine. Yes, we do have a product. It's called JU40, which is a 5-axis machine. It has been in the market with a few customers, but from a market size standpoint of view, 5-axis in terms of a percentage of market share is not the highest, right? It does hold a very low market share in terms of all the other machines from 2-axis to 3 to 4 to 5. The 5-axis machine holds a lower percentage. But we do have a 5-axis machine which is available, and the model number is JU40. It is available with us. But the question what you're asking in terms of electronic component machining, it comes under a different category, what we call machining centers, which are smaller machining centers. The model what we have for that is J1 and J2, what we call them, are the machining centers which we sell for electronic machining. I can't get into the specifics of supply to a specific customer, but these models are available, these machines are available, and it is not just for the customer of Foxconn, right? As a Foxconn as a customer. It is also, these machines are also used in the immediate ecosystem of supplier base to Foxconn. So they make tools and dies, they make holding fixtures. So these machines also get used in that particular segment. These machines are actually much smaller in size compared to a larger 5-axis machine. So that's so I hope that answers the question what you asked.
Sir, I was referring to an news article that was there where there was a news that Apple is scouting for a new supply vendor in India for its factory which is coming up, and the article also suggested that it is in talks with LMW. Earlier also, I think so, LMW had participated in one of the tenders that Apple had floated, and I think so we couldn't qualify over there, or it didn't go through because of the commercial reasons. So just wanted to understand on that particular tender, what is the status and what kind of opportunity that it provides for LMW if it goes through.
Okay. I think yes, there has been a couple of articles which has been going around in the social media. What we can confirm basically is that yes, we have been able to and we have participated in various discussions with the customer. We have developed a product. We have been able to successfully deliver the product as well. And that is the product which I just now mentioned is available for sale. And it is available not only for the customer, but it is also available for the ecosystem. I think it's in a generic term, we call it drill tap centers, we call it, in our mission model, we call it J1 and J2 models. And the volume of business within India for this particular type of machine in itself is closer to 7 to 8,000 machines or a little bit more per year from the Indian ecosystem point of view itself, and without considering the new EMS which is coming in, and this I'm just talking about one machine. So definitely the machine for EMS application is quite highly in demand, and we do have a product. But I'm sorry, I can't specifically go into a customer or the internal dealings because they're all subject to confidentiality.
So thank you so much for answering that one. Thank you. So as of now, we do not have any further hands raised. Okay, I believe Mr. Jay has a follow-up question.
Yeah.
Thank you again, Senthil. Is it fair, Senthil, on the textile machinery division today to assume that on the available capacity basis, we are running at the lowest utilization we could have had in closer to a decade, time frame wise? And other than 2020, the exception of COVID year is fine. But other than that, I think if I put an average of X of 2021 on an other 8-year basis, utilization would be at the lowest ever. And Senthil, I wanted to understand that since a lot of our competition, if I may, stems from majority Europe, some part Southern Asia, has given this experience of lower utilization to maintain profitability made us very, very cost competitive, at the same time being able to offer better products that we have launched in the last few years, suggesting such that in any recovery cycle, we would come back much stronger on revenue recovery and profitability as a combination?
Okay, absolutely spot on. I think probably I will take the second question first. Yes, and there are two reasons why we tend to be cost competitive, right? One is we tend to continue to invest during this time, and it's very, very important that we continue to do so. We continue to build the lower cost and lower high efficient plant. And at the same time, NPD, and in fact, we did mention, I will repeat, in fact, the three machines, what we launched in ITMA in Singapore, will definitely showcase the fact that we are investing not only in the plant but also in the products. And when the recovery happens, we have capacities, and the current capacity utilization is actually sub 50% is what we have. So there is, and we know where we have reached also, right? Post COVID, when you have hit the high numbers, we know what we have reached. And the cost base would not be very elastic. It would be inelastic. So definitely we will have to bounce back stronger, and we will bounce back stronger. Like I said, for us, it's a very tried and tested business cycles what we see. And if you actually go back and if you are looking at all the previous history, you will see that every 8 years there has been an upswing and a downswing, right? Subsequent 8 years, and every time we have come back stronger with better products and products which are relevant to the market. What is more important is it is not just efficiency on the product. The product has to also be relevant. Today, the what the customer runs from cotton, especially if you look at the spindlage which is there in Tamil Nadu, from a cotton it has become a blend. The products have to be relevant to the respective markets for us to be competitive. And even more telling is the fact that today India produces the most cost-effective yarn at the moment. And in fact, if you refer this to the reasons, the news, what you see, for example, the other countries where yarn is getting exported, there is a lot of requirement of yarn in China from India. There is also there is actually some challenges to export into Bangladesh because they feel the cost of yarn is so much better here. Because again, one is the cost of the raw material itself, but the energy cost and the conversion cost, right? So these machines, what we make has to make sense and be relevant, and that is what we do, Mr. J, during this downtime. Uh, it, we will definitely emerge back stronger. And what will we have seen a what do you call a not a K or a V, whatever we call it. There is a huge upswing post COVID. Whether that is going to come or not, we do not know. But we just tighten our belts and wait till that moment comes. Over to you, Mr. Samir.
So thank you so much. Going ahead, I believe Mr. Amit Shah has another one.
Yeah.
Amit sir?
Thank you, sir, for the follow-up. Sir, in terms of value, you told me 8,000 volumes is the market for the J1, J2 machine. In terms of value, what would be that size, sir?
See, these are quite broad numbers.
Yeah.
I mean, you can. The generic name is they call it Diltap centers. You can take an average amount of around 30 odd lakhs for these machines. Anywhere from 25 to 30 lakhs you can take for these machines. But this is, since the answer basically was for your specific question, which you asked on the machining centers for small electronic components. This machine tool division is such a vast variety of machines are available, right? So you are making long shafts for what do you call the oil business. You are making small engines. So the plethora of machines, what is available, the models which are available, it's enormous. It's a big ocean, right? The industries to which it is applicable, it's a big ocean. Since your specific question was respect to that particular one model, as I understand, my reply was for that.
Sure,
Okay.
sure. Sir, last question from my side. The recent commodity price increases, right?
Yes.
What is the kind of strategy that we are following in terms of, say, price hikes across product portfolio, or do we need to absorb the cost increase given the muted demand that is prevailing in the market, both in the TMD, if you can highlight even on the MTD side?
I think brilliant question. Yes, commodity prices are going up. We have our own process through which either we look at alternates. There's a value engineering work which we do. But as of now, considering the market as it is, there is no way we feel that it is something which can be absorbed by the market. But we do a lot of internal work on the pricing and the cost, etc., to compensate for that.
So, sir, can we expect any near-term margin pressure because of the cost increase, or we believe that value engineering that we have done internally should help us to keep the margins intact?
Yeah, I think the percentage of commodity cost which is going up is not uniform across all commodities, right? And that as a percentage of the machine price is also not very large. So yes, there will be cost margin pressure, but we are not discussing in terms of particular percentage here. But for businesses like Foundry, we got a clear pass-through clause with the customer. So whatever happens, we pass through, and the margins are safe there. With respect to Advanced Technology Center, also, these are all prices which are backed by contracts with the customer. So if there's a price increase, there's an immediate price revision there as well. In the other two businesses, we don't see a major impact on account. Over to you, Mr. Samir.
So thank you so much. We have with us Mr. Samarth. Mr. Samarth, we are ready for your questions.
So two questions from my side. So in the machine tool division, can you share the mix between the turning centers and the machining centers? And in the textile machines, so when we like if India has a FTA and more volumes come to India under the FTA, so if Bangladesh, Vietnam and these countries, probably if they have lower volumes, so does this impact our exports which we are doing to these markets? And considering the exports made slightly better margins for us, so can you talk on this thing? Thank you.
Can you repeat the second question, please? I didn't quite understand what the question was.
So Bangladesh, which is a large which supplies a lot of garments to Europe, so they rely on a lot of yarn being imported from India. So if India wins, if India gets some share from Bangladesh, so does it impact our export business in Bangladesh? That was the question.
Okay, I think with respect to MTD, the machining center, turning center, you can take a percentage of 75% turning centers and 25% machining centers.
Okay.
With respect to the business within Bangladesh, see, it is a two-way, right? One is if the local spinners are able to spin, do they have enough capacities? The answer to that is definitely a no. They don't have enough capacities. Can they import 100% of the yarn? Technically, yes, but would they want to import 100% of the yarn? Probably no, because there is a value addition concept, right? As a country, they would like to add more value internally, so they will still prefer to get fiber and spin it into yarn, because that, of course, gives them employment, etc. So I think it is not such a clear-cut case to say that, okay, no country is going to replace that with 100% import or 100% local manufacture. So there will always be a balance in these cases. So we believe the market forces would on its own decide what the balance is, and the balance is based on the cost of production for them, what type of mix they would like to do, what is the turnaround time for the final garment for them. So there are multiple factors affecting it. But we are of the opinion that a stable market, a stable economy there, and a stable geopolitics will help us them to further come back into the investment cycle. Over to you, Mr. Samir.
Thank you so much, sir. So do we have time for more questions?
I think Mr. Jay has held his hand up. So yes.
That is why. So Mr. Jay has a few questions.
Sorry, and thank you, Senthil, again. So just wanted to get a sense of that part two of my earlier question, that you explained how our offerings have improved and how we have efficient, cost-effective offerings from our LMW stable. But I asked if there is any weakening or consolidation of other suppliers or our competitors, specifically in Europe and the southern region, given the change circumstances and the lower demand and the higher cost in terms of employee and power that they must be experiencing?
You're talking about the consolidation of suppliers, I mean, our competition?
Yes, in textile machinery, along with the fact
Textile
that
machinery.
yes,
Okay.
and the kind of cost structure changes that they would have experienced in the last 5 years, specifically in the Europe region. Yeah.
Okay. No, I think, Mr. J, first thing is that the entire the machinery manufacturing to a large extent, in fact, to a probably 95% and above extent, has moved to, of course, in India and also to China, right? So the benefit of having the cost advantage is already being taken by the competition, and all the competition is here. And we are very well, we have to work within this, and that is not a new thing for us. With respect to consolidation, no, I think with a handful of suppliers, it is not so. But what is probably, I would say that in machine tool, it's going to be more interesting because with what Europe is going through, there's a lot of challenges there. I think it is machine tool because uh, it is more important. What is happening more is that India is becoming a very good manufacturing hub and a lot of manufacturing activity happening. So we actually see a lot of competition coming in machine tool, and that is where we everyone is expanding, everyone is getting NPD, etc. So what you're saying for textile machinery has already happened, and we expect it to happen in the machine tool over the next 5 years. Okay, thank you. Over to you, Mr. Samir.
So thank you so much. Sir, at the moment, we do not have any hands raised.
Okay.
So would
Thank
you
you.
want?
Thank you. Thank you,
Okay,
Mr. Samir. I think we can conclude here.
sure, sir. Thank you so much. Hence, this brings us to the end of all of the questions from all of the people who raised their hands. Thank you so much, sir, for helping us with the answers on all of those. And thank you so much, everybody, for joining this call. Thank you so much.
Thank you. Thank you, everyone. Bye-bye.
Also, can I end this WebEx meeting?
Hello, Nizar.
Yes, I can end this WebEx meeting.
Yeah, Nizar, you can end the meeting and you can share that audio and video recording. So MP3 and MP4.
Okay, sir. Yes, sir.
Okay, thank you.